Vipshop missed consensus on both the top and bottom lines for Q2. Revenue came in at $24.71 billion, which, slightly missed the $24.88 billion estimate.
Right, but the real shocker is the bottom line. I mean, non-GAAP EPS took a steep 26% miss.
Yeah, landing at $2.91 versus the 3.94 forecast. And looking ahead, Q3 revenue is projected between RMB 20.3 billion and 21.4 billion.
Which basically implies a 5% decline to flat year over year.
Exactly. So shares slid 2.93% in the pre-market down to $13.90, though aggressive dip buyers actually managed to drive it to a flat close at 14.32.
They really stepped in. But, if you are looking at the earnings report from our stack of sources today, the numbers are just a masterclass in accounting whiplash.
Total whiplash. And our mission for this deep dive is to cut through that massive financial noise and just, figure out what is actually happening beneath the surface here.
Because if you just look at those headline numbers, you're missing a fundamental identity crisis at the company.
Yeah, let's start with that specific disconnect, because it honestly doesn't make logical sense on first glance.
No, it really doesn't.
We are talking about a minuscule, a 0.68% miss on revenue. How does that practically translate into missing your earnings per share target by 26%?
Well, it comes down to a brutal margin squeeze, mostly fueled by product returns.
Okay, because gross margins actually held steady at 23.3%, right?
Exactly. Gross margins were fine. The damage happened further down the income statement. Operating margins slipped to 6.2%.
Wow.
Yeah, what we're seeing is a sudden, sharp spike in the rate of customers returning their online orders.
Wait, so a higher return rate isn't just, lost revenue. It actively destroys their operating leverage.
Right, because they still have to pay for the shipping, the warehouse processing, and all the restocking.
Oh, that makes sense. So you pay for the logistics but get none of the sale.
Precisely. When your top-line revenue is shrinking, but your fixed costs and fulfillment expenses are climbing, your bottom line just takes a disproportionate hit.
And that brings us to the core of this identity crisis. The traditional online flash sale business is bleeding right now. Active customers dropped to 42.3 million.
Yeah, but then you look at their offline physical segment, the Shan outlets.
That part is absolutely booming. Gross merchandise value there surged over 20% in the first half of the year.
It's crazy. It feels like a tech company suddenly realizing that, selling physical clothes in a brick-and-mortar mall is actually their best lifeboat.
Yeah, and management is clearly seeing that same shift. On the call, CEO Eric Shen cited a challenging retail environment.
Right. He noted that Chinese consumers are currently highly selective.
And they made a firm point that they will not chase unprofitable growth or, get dragged into a margin-crushing subsidy war.
Just to prop up those fading online metrics? Yeah, they're not doing it.
But here's where I really need you to help me understand the mechanics, because the net income reporting is just chaotic.
Oh, it's a total mess.
If you look at their GAAP net income, it actually spiked 189%. But then their non-GAAP net income basically vaporized, cratering to just $57.8 million.
Yeah.
How do you have a nearly 200% spike and a total crater in the very same quarter?
Well, the 189% GAAP spike is entirely an optical illusion.
Really?
Yeah, it's driven by a one-off asset play. Vipshop took two of those booming physical Shan outlets and listed them as a commercial REIT.
A real estate investment trust.
Exactly. By spinning off those physical properties, they booked a massive RMB 5.79 billion gain.
Ah, so it artificially juices the GAAP net income?
Right, but it has absolutely nothing to do with selling more discounted clothing.
So they basically sold off the mall to boost the GAAP numbers. But what about the non-GAAP drop then?
Our sources show that was triggered by an RMB 1.56 billion withholding tax adjustment on historical dividends.
That sounds a lot like management finding a highly convenient quarter to bury some bad news.
It's a fair suspicion, for sure.
Yeah.
But management pushed back hard against that narrative.
What did they say?
They framed this tax hit as a necessary proactive compliance step to clean up historical offshore repatriations.
So they are insisting this was purely administrative house cleaning.
Right, not a sudden regulatory penalty dropping out of this.
Still, that is a lot of volatility for a retail investor to digest.
Oh, definitely.
It makes sense why Vipshop authorized a brand new $1 billion share repurchase program right alongside this report.
Yeah, a massive buyback.
Because if your core online business is shrinking and your earnings are a mess of tax hits and real estate spinoffs, A buyback is a quick way to keep those dip buyers engaged.
Put a floor under the stock price,
Yeah.
exactly. It's a classic capital return strategy to just buy them some time while the underlying business model shifts.
Right. Well, if you want to keep tracking these daily earnings breakdowns, make sure to follow along for our next deep dive.
For sure.
But for now, if you hold Vipshop, I want to leave you with a final question to ponder.
Okay, what is it?
If these physical Shan outlets and commercial REITs continue to vastly outperform the legacy online platform, is this former e-commerce darling quietly transforming into a traditional brick-and-mortar landlord?